Hello everyone, welcome back to our Memory Lane series where we explore remarks from renowned economists. The Better Policy Project, in collaboration with the Central Bank of Armenia and the National Bank of Georgia, wishes to express profound gratitude to all advisors, particularly highlighting the contributions of central banking expert Larry Summers. In this video, Summers discussed the prudent risk management in monetary policy at a symposium in the Dilijan Research and Training Center. He emphasizes the importance of scenario planning, adversarial processes, and humility in macroeconomic policy. Summers highlights the need for central banks to consider multiple scenarios and avoid over-reliance on single models. He suggests these strategies could improve responses to financial crises and inflation. Summers concludes with reflections on the unpredictable nature of economics and the value of learning from past mistakes. Check out the full video for more insights from his speech.
Good morning.
Good morning.
Great to see you. How are you?
I am very well, my friend. How are you?
Doing well. Thank you very much. So let us start. Hello everyone again. It is my distinct privilege today to introduce our final keynote session for this symposium featuring an individual who has served as an important inspiration for us at the Central Bank of Armenia on this journey to develop a prudent risk management approach to price stability. This individual, of course, is Larry Summers, who doesn't need any introduction, so I will only say a few words. So Larry Summers is a Charles W. Eliot Professor, University Professor, and the President Emeritus of Harvard University, and Wheel Director of Mozaffar Rahmani Center for Business and Government at the Kennedy School. During the past 3 decades, he has served in a series of senior policy positions in Washington, D.C., including the 71st Secretary of Treasury for President Clinton, Director of the National Economic Council for President Obama, and Vice President of Development Economics and Chief Economist of the World Bank. Larry, I'd like to express my thanks for inspiring us over the past several years to reflect deeply on what constitutes a sensible and prudent approach to monetary policy amid heightened uncertainty and significant risk. In particular, we are grateful for the feedback you provided us back in July, which have helped guide our development and journey since then. Later in this session, my colleagues Armen Nurbekyan and Douglas Luxton will respond to 2 questions that you asked us in July, which related. One was about open economic considerations in the new framework, and the second one was how a scenario-based approach might have worked in a period where downside risks were more serious, such as global financial crisis and after recovery period after that. Before handing it over to you, I'd like to very briefly provide a bit of context for our audience about our novel framework for a prudent risk management approach of monetary policy, which we refer as FPAS Mark II. The framework represents an attempt to address in a structured and systematic way what we believe to be the greatest policy imperative of our time, appropriately dealing with the elevated role of risk and uncertainty in policymaking. This is achieved in 2 ways. First, instead of trying to develop expert forecasts of the most likely future, we transparently focus on understanding and communicating the key sources of risk and uncertainty moving forward. And the second, we pay particular attention to uncertainties, particularly for those non-linearities that could push economy into dark corners of price or macroeconomic instability. To turn to the substance of our discussions, as you have noted extensively in your interviews and writings, the COVID crisis and its aftermath have placed enormous stress on existing central bank frameworks in terms of both analytics and communication. If you have read our main framework paper or our forthcoming framework book, you may have noticed that your voice features prominently in it. First, we were heavily inspired by the language you used in the past interview forbearance where you stated that forward guidance is the vast majority of time folly. We interpreted that as a challenge. We see the folly in forward guidance as being interlinked with a reliance on a single baseline forecast. The other issue, of course, is the often uncritical reliance on linear models to produce these baselines. We also adopted the notion of adversarial collaboration within our own institutional framework. So our framework typically includes two illustrative case scenarios that build the best argument for why policy path should be higher than what is currently priced in the financial market. And we call it this case A, and the opposite case for why the policy rate should be lower than the market expectations, which is called case B. Finally, we provide an example in the paper and the book on how the new framework would engage the transitory versus persistent inflation debate of 2021. We argue that using a scenario-based approach could have perhaps allowed advanced economy central banks to have more quickly responded to inflationary forces and minimized some of the adverse impacts of welfare and credibility. Larry, I would like now to give the floor to you and provide you with an open-ended opportunity to reflect on the recent experience of past several years. And in your view, how have these recent experiences changed how central banks should conduct and communicate monetary policy?
Let me thank you very much for including me in this symposium. Express my gratitude to you for the chance to provide you some input as you worked on this important document. Share a strong sense that the work you do is immensely important for your country, because sound, well-financed money and finance cannot make a country rich, but mismanaged finance can make a country poor. And so in some ways, it is the lot of central bankers to be like anesthesiologists. When I go for my surgery, there's no such thing as a great administration of anesthesia. But if the anesthesiologist becomes highly prominent, it's not probably because something good has happened, but it's because of something unfortunate that has happened. Nonetheless, the development of better anesthesiological practice contributes greatly to the preservation of human health. And in the same way, more robust, more reliable central bank frameworks seem to me to be very important. I'm also very much aware of the dangerous part of the world in which you live, and your ability to step apart from the immediate and political to do so serious a piece of work seems to me to be something that is highly commendable. And it is my hope that both the substance of your framework will generate substantial discussion with other central banks in other places, and that the seriousness and the thoughtfulness of the process you undertook will be a model as other countries set their approach going forward. I am struck as a general theme by an epistemological point, which is that all of us, in thinking about macroeconomic policy, need to operate with enormous humility. There are different words for it. One can think in terms of unknown unknowns. One can think about shock uncertainty, parameter uncertainty, model uncertainty as all being elements of the system. One can think in terms of Frank Knight's celebrated distinction between risk and uncertainty. All of it is one can think of Nassim Taleb and many others' emphasis on factales and the non-normality of distributions. All of it is in common service of the broad idea of epistemic humility. We don't know, and we don't fully know all that we don't know. This is brought home to me by one of the many mistakes I have made in life. I remember being of the view in the 1980s that the liquidity trap was some kind of historical curiosity of primary interest to economic historians and without future relevance. And then Japan happened. And then the financial crisis and the zero lower bound happened. I remember being of the view in the aftermath of the Clinton administration that high inflation was like smallpox, a disease that had been eradicated in major countries. And that proved to be wrong. So I think the broad challenge, and I'm really very impressed by the ways in which your central bank has reacted, is on several levels. That there is a desire on the one hand to be analytic and rigorous and statistical and econometric and formal in one's approach, but that doing all of those things drives very much towards choosing a model, manipulating that model, and operating that model. And yet, no model is capable of capturing an inherently unstable world. And indeed, there is the extra aspect that some would call recursion, that some would call reflexivity, that represents a profound difference between economic and physical systems. It is the essence of the celebrated Lucas critique. The laws of gravity are unaffected by the work of engineers. The laws of economics are affected by economic policies, economic policy choices, and how they influence how they influence the behavior and the formation of expectations. And so it is the challenge, it seems to me, to respond to those realities and yet not throw oneself back simply on the idea that there will be wise people who will scratch their beards and then say what is to be done, because no model or framework can work. And so I think of the task that you have been engaged in as recognizing this profound need for humility, while at the same time still having method, framework, and formality. From that perspective, I'm impressed by three aspects of your work as I understand it that correspond with things that I have always tried to do as a decision maker, though I think you have brought a degree of formality to the exercise that goes beyond things that I have ever been able to do. I think that you are very right and important in your emphasis on scenario planning. We don't know. We don't know what is going to happen. We don't even know what the distribution of possible outcomes are. The systematic use of multiple scenarios and the desire to formulate policies that are robust against all scenarios seems to me to be something that is very important. It is not the same thing as the point about tails, but it is related to the point about tails. And it is, of course, connected to wisdom about private sector financial practice. There is the old story about the guy who has a strategy. He goes to the casino with $10,000 and he plays until he either has $11,000 or has $0. And he reports back to his wife that he has used his strategy 5 times, and each time he has won $1,000. And he concludes that he has a foolproof strategy for making $1,000, that he has empirical evidence of a Sharpe ratio of infinity, and that he now needs to go 10x on this strategy and increase the frequency with which he plays. That illustrates the danger of failing to recognize nonlinearities, of failing to recognize a full range of possible scenarios. So I think your emphasis on scenario planning is something that I would very much salute. A second aspect of your framework that I would very much salute is the adversarial aspect, the attempt to probe possible error. There are many decisions that have the character of decisions as typically portrayed in decision analysis textbooks. Should I choose option A or should I choose option B? Should I undergo surgery? Should I not undergo surgery? Should we go to war? Should we not go to war? Should we initiate this program? Should we not initiate this program? But there are also many, many decisions in life that are best characterized as exercises in calibration. Where should we set a policy interest rate? How much money should we devote to R&D spending or some other worthy cause? How long should we allow ourselves to prepare a given report? In all of these cases, one is seeking to optimize a variable that, broadly speaking, is continuous. It is one of the most fundamental theorems of the calculus that at a maximum, the first derivative is zero, or that at the top of a hill, whichever way you turn, you go down. That means that if the arguments for moving up are stronger than the arguments for moving down, you are not at a maximum. And so attempting to pose both the considerations for more and for less, for higher, for lower, and to verify that they seem to be in equipoise as best one can make a judgment, seems to me to be very much something that is appropriate and is a valuable contribution to the policy process. The third thing I would say is, and I think that your movement is a constructive one, is that one needs to be very careful to protect one's credibility in an uncertain world by not pretending to know more than one actually can. Of course, one needs to make and refine the best judgments that one possibly can, but those judgments will be inherently flawed. And therefore, one needs to not express oneself with excessive confidence in their favor. My wisecrack over time has been that central bankers used to, but in too many cases, no longer understand what the oracles of Delphi understood, that if you are seen as omniscient and omnipotent, but are in fact human and somewhat clueless, it is best to keep your pronouncements vague, oracular, and unfalsifiable. And that may be going too far, but it is, I think, capturing some wisdom that is potentially quite important. Or to put it at its most cynical, forward guidance fails. The market doesn't believe it when you give it, and you feel bound by it down the road. And so it inhibits flexibility without enhancing credibility. That may be an overstatement in a variety of contexts, but it is, I think, a useful caution. I would just conclude by describing an exercise that I have found useful in organizations of which I am a part, which is to focus on working history back from the future. I like to ask organizations of which I'm a part 2 questions. If we look back from 5 years from now, and we are regretting our collective failure, what is the most plausible way in which that will have happened? If we look back from 5 years from now, and we are celebrating extraordinary success beyond which anyone had hoped that we would achieve, what is the most plausible scenario by which that had happened? And that tends to force thinking about both the dark and the bright corners, the extreme end of the tails of distribution. And I think, therefore, ironically, has the effect of both increasing prudence and increasing creativity. And there's, I think, a useful exercise for committees, fallible humans. And so those are some reflections on your framework. And again, I look forward to a bit of conversation, and I'm grateful for the chance to have been included in your deliberations, including today. Thank you very much.
Thank you very much. May I have just one small follow-up question on that? Do you think that the developed countries' central banks used whatever you just described during this last couple of years? And do you think that our framework could be useful for them in thinking about the problems?
I think that they have, I think, had a bit of a tendency to be overly slavish to single internal models and consensus forecasts. Something I got very right, I think it's fair to say, is the degree of inflation that the United States suffered in the aftermath of the massive fiscal stimulus and COVID several years ago. I think that central banks would have done a better job if they had perceived that risk in a more salient way. And I think if they had engaged in more adversarial process and they had put more emphasis on a multiplicity of scenarios that considered how their base case views could be wrong, I think they would have been less prone to make that kind of error. I think in a similar way, with respect to financial stability, the linear mechanical character of stress testing has tended to impart an excessive bias towards optimism with respect to the risk of financial crisis. So I think the ideas that you're introducing and the types of approaches you're recommending are useful in those regards.